Hi everyone, we were recently asked a really good question at Hewison Private Wealth, and that is what caused the global financial crisis, the GFC, and how is it different to the current pandemic and what we're seeing in markets at the moment? And it's a really great question because it helps to highlight that not every market event is the same. In fact, they're pretty much all different because we generally learn lessons from each one. So every time a new market event happens, it's generally because it's for something that we haven't seen before or haven't seen for a very long time. So first of all, they are entirely different and they impact different areas of the market. So starting with the GFC, and in a very, very tight nutshell, it basically happened because of very, very greedy people and companies and huge, huge amounts of debt. Unfathomable amounts of debt. Now what happened was banks were issuing loans to people and they were using their home as collateral, a mortgage. And what they did was they basically sold these mortgages to investment companies, and they would get thousands of these mortgages, these great A-grade mortgages, wrap them up together in an investment product and sell that product to investors. And it kept happening over and over. And in the early thousands, they became really popular, and it was making these investment companies and the banks huge profits and massive amounts of money. So the greed kicked in and they wanted to keep going, but they ran out of the best people that were borrowing money. So they started lending to people that on paper really shouldn't have been borrowing money in the first place. These people weren't really able to meet their mortgage repayments, the loan terms were not good, and basically these investment products that were made up of lots and lots of mortgages, they became worse and worse quality. But the credit rating agencies, so S&P, Standard and Poor, or Moody's, these people, they basically rate investment products and evaluate their credit worthiness as to how risky they are. They were still giving these average, subpar, or you may have heard subprime mortgages AAA credit ratings, which means they were effectively, you call it bulletproof, really, really safe investments, but they were not made up of good quality investments at all. So eventually time goes on, rates change, people aren't able to meet their mortgage repayments, the housing market crashes, that flows through to basically investors pulling all their money out of riskier type assets like property, like shares, and just buying safer treasury bonds, government debt, and basically going to the run to safety, if you would. So this whole incident impacted markets everywhere, and the US share market halved in value at the end of the global financial crisis. So very, very serious, impacted the top end of town. So that's the global financial crisis. This is completely different. This is medical related. We're seeing lockdowns around the place. Businesses aren't able to trade the way that they normally can. It's affecting everybody, not just the top end of town anymore. This is affecting absolutely everybody. And it's not just financial impact, it's emotional and physical impact as well. We can't really go out and do the things that we want to, or at least in Melbourne, we can't do it right now. These are the main things that are occurring. So they're nothing alike, but what they show you is that things like this, when they come around, they might all be different, but if they create uncertainty, then they create volatile markets that jump up and down in value one day on the next. So they can have the same effect, but they often affect different people, and they come about because we're not expecting something to occur. I hope that was helpful.